G'day traders, welcome to the Algorithmic Advantage. We've got a fantastic show lined up for you, our first guest interview, and it is with Moritzs Seibert and Moritzs Heiden from Takahe Capital. Their website, if you want to get in touch with them or check out the fund, is takahe.capital. That's Takahe.capital. Takahe, by the way, is the name of a bird from New Zealand. If you want to know why they named their fund after that bird, check it out on their website. It's an interesting story. So a couple of very quick points before we launch into the show. One is that we spoke to the guys for almost 2 hours, so we've split it up into 2 shows. This is part 1. Check out part 2. Apart from that, we did have a few audio issues. I think I've sorted those out, so bear with us as we continue to learn the ropes. And finally, we did mention in the show a Jerry. By Jerry, of course, we mean Jerry Parker, the former turtle trader and now manager of Chesapeake Capital. So with those little clarifications, let's launch into the show.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Welcome, gentlemen.
Thank you, Simon. Thank you, Richard. Good to see you both.
Yes, great to see you both.
Great to be here.
Let's just kick off very casually. We've just been chatting already. We want to continue that kind of casual vibe. We're obviously interested in some of the practical side of what you do, how you trade, and the kinds of strategies that you run. And also just picking your brains about anything that's taking your attention at the moment, or that's of interest to you, anything that you'd like to chat about, and we'll just see how we go. So look, let's just start off with a bit of a background so that we can get familiar with the both of you. I know you've both got some interesting backgrounds, so maybe Moritz S, we could start with you. You could just give us a really high level how you got into trading and to what extent your background sort of influenced where you arrived at with your trading now.
Yeah, sure. Happy to. Probably the reason I'm trading today is because I failed at a tennis career. So this is more than 20 years, way more than 20 years ago now. And so the next best thing up was, join an investment bank. That's where all the money was, become a derivatives trader, entered the structured products industry. That's what I did. That was probably until the end of 2011, the stuff that I was doing, working for banks in the UK, in the US, trading derivatives, mostly on the equities and commodities side. But I always had an interest in systematic trading. Very early on, developed my first trend following type of trading models, simple stuff, moving averages and all these type of things. Curve fitted everything to death, because I just didn't know any better. You think you have a Bloomberg terminal, you throw some data at it. It kind of works, but you always feel like, hey, I must be able to do something better than that, right? So, you turn the screws and you add the bells and whistles and more parameters. Richard knows that. It takes time and education and experience to kind of move that back into the background and stop doing that. That is actually part of the journey as well. But anyway, you wanted a brief intro. So yeah, started a systematic CTA called a Quantum, ran that for a period of time. Then I got to know Moritzs H. We worked together mostly at Munich Reinvestment Partners, where we had essentially an internal quantitative hedge fund, and now we're running Takahe Capital, kind of like our second shot at systematic trading. Very young firm, only just started, but it's a ton of fun.
And you're both out of Munich RE now, with this Takahe's occupying you 100% of your time?
For me, for sure, definitely out of Munich Re and everything else since more than a year, 1.5 years, more than 1.5 years even. So yeah, that is absolutely my only focus.
And you both hail from the southern parts of Germany, and I think you're close to the border of Austria, Moritz. Now, I mean, look, I love my surfing and mountain biking and all of that kind of stuff in Australia, but when in Europe, I love snowboarding. I actually spent an entire season in Kitzbühel in Austria many years ago. Have
Quite
you been
posh.
there? I know you like your skiing, right?
Yeah, I've been to Kitzbühel many times. This is about 2.5 hours drive from where we live. If you could look out of that window, which you can, you would see the Zugspitze, which is the tallest mountain that we have here in Germany. It's close to Garmisch-Partenkirchen. That's about 45-50 minutes by car from where I am. So relatively close to the slopes, close to the Austrian border, as you say, and I do love my skiing. I've got 2 kids. One is snowboarding, the other one's skiing. It's a great family sport. Everybody's out, everybody's together, everybody's having fun. And you can also have a beer or a drink afterwards, which I don't mind either.
That's so good.
And you recently came back from Thailand with your family. Did you had a bit of a holiday over there?
Yeah. Just 3 or 4 days ago, we got back from Thailand, where we spent 2 weeks of vacation, summer vacation. To be honest, Richard, I probably should have stayed in Europe. We had great weather here, and there's a little bit of a rainy season in Thailand. So we had 5 days of really nonstop, solid rain. It was it was really binary. It's like, flipping a switch. It starts to rain quite heavily, and then it just doesn't stop for 5 days, and then it stops. But for those 5 days, you're do some reading, go into the pool regardless, but it's a little bit boring then.
And Moritz H, you've obviously had an interesting academic background. Can you give us a little bit of an overview? And I'm interested to know to what extent, the work you did, say, in your PhD and the likes, whether that stuff directly influenced your trading, or have you sort of since developed other ideas, and how's that journey been?
Yeah, absolutely. I mean, my background, just briefly, is background in math finance. I did a PhD in statistics and finance, did mostly research on alternative data sources, multivariate volatility models, which sounds fancier than it really is, right? You're looking at dependency structures which are non-linear and very, very big spaces on high frequency data, and try to make something out of that. And to the extent that it influences today's trading, I would say I learned over the years, like in academia, we are the kings of overfitting, right? So the more parameters, the better. And then you kind of like do a little bit of testing. We are kings of back testing as well, but then you only take the curve which goes up. That's a cruel reality. So what I've learned, and learned that mainly from Moritz, is also that sometimes you just have to keep it simple. I mean, I've always been a fan of simple models, even in the PhD study, try to keep everything as easy as possible, as understandable as possible, which kind of like benefits our trading today. I do not use the complex models which I've used back then for different reasons. They are very data hungry. They are prone to overfitting. They are very hard to handle really in a realistic setting. And most of these models are used, I would say, in risk management to manage large books at the banks, which is a different target setting. But still, sometimes you can take some things away from this. So there are some very interesting models which can help you, which are from the trend following world or closely related. And also some of the concepts, honestly, they are now sometimes sold, at least in academia, as new concept, are known to you guys in the trend following world. For example, if we are talking about average true range to determine position sizes, this is in academia known as alternative estimators for volatility, usually range-based estimators, where you have a whole range of these things. And most of the traders, they have known the, I would say, positive and negative side of these things for years, probably since the 70s or something, when the first of these estimators come out. But like academia at some point discovered or rediscovered that stuff and made it whole topic in the volatility estimation space, which is super interesting and benefits us today in the sense that we kind of like know where the pitfalls lie and which we can use and know which direction to go if we want to look into those things in more detail.
Fascinating. And I guess, Moritz S., with that background in, structured derivatives and so on in banking, and I have a little bit of an experience in investment banking in my background, not to the extent that you have, but my question always is, to what extent does it help when you leave that environment and you actually need to set up your own trading, manage your own money in particular, and you're looking at things from a very different angle, and you're not obviously you're not in the well, especially if you're going from, say, the sell side to the buy side. But when you actually need to sit down and create your own models, how much do you draw from that background?
Not that much, honestly, Simon. I think what I did inside the banks, and by the way, I had a great time there. It has been an amazing learning journey, because when you look into these derivative models, like, stochastic volatility models, how do you price them, Monte Carlo simulations, all that type of stuff. We were trading very exotic options. Those were, of course, vanillas as well, but, you had all sorts of whatever, like range accruals and barriers and up and down knockouts, all that type of stuff. So that is, like, from an intellectual perspective, how do you find an estimator for the value or the price of that derivative? I found that very interesting. So I like that, but it has absolutely nothing to do with the trading that we do today, because we're not really depending on, exotic derivatives or, say, the price of a structured product. It's just not stuff that we trade. But obviously, we were looking at futures markets. We were, delta hedging, trading all these markets. This helps today in terms of having an understanding of, liquidity, how to trade them, when do contracts roll, what is the best approach to actually get into the order book. That type of stuff is valuable, but it is, it's a good thing to know that, but you could run a systematic CTA trend following business even without that background. No problem at all, I'd say.
And tell me, what I'm interested in is how your partnership emerged between Mortiz S and Moritz H. So have you both migrated towards sort of trend following momentum, the tail regions of the distribution? Is this something that you've naturally both migrated to? Or is it the case that Moritz Heiden is just a great programmer, Moritz S, and you just use him for his programming abilities? I know I certainly do in Australia with my co-partner Fred, who's a programmer. He's the intelligent one and I'm just the front man. So I'd be interested to know how you developed your relationship together, and do you see eye to eye, and do you sort of have the same philosophy and underlying principles that guide you together towards your solutions?
Yeah, look, I can start and then Moritz can say the opposite, but no, we're good friends. I mean, this is amazing. We're working together, but we're also good buddies. And I think we got to know each other in, was it 2015, 2016? I always get the year wrong, but sometime around that period. And that was in Frankfurt. So we were working for an investment management firm. We were then working together at.
It wasn't in a beer house.
No, it was actually for a change, not inside a beer house, even though we do go to these places. We don't necessarily mind that. Look, I was trading my own money. I think Moritz was coming out of his PhD. He is a much better programmer, and back then it was, I think you were programming in R, and now it's Python and all that type of stuff. So we just found that relationship where we both have a very strong interest in trading, quantitative, systematic trading, not discretionary, long short equity or anything like that. Yeah. I had some infrastructure that was honestly largely based in Excel at the time. And why not? You can do a lot of stuff in Excel, by the way. And, Moritz was able to bring a new perspective and a new environment and testing to that with Python and all that. So this is how it started. And now we've been doing many things together, actually. It's not just Takahe. You've heard of Quants maybe. We've done stuff together for Real Vision, some crazy projects on the sides related to NFTs. I mean, it's always interesting.
So what do you bring that's different? Sorry, Rich, I was going to ask, what's different that synergizes? You're obviously not the same. What are the contrasting skill sets, if you like, that you bring that make the synergistic whole?
Oh, Moritz is a talking quant. I'm the coding quant. No, we say that jokingly. Reality is, to be honest, Moritz has a trading experience much more than I do. I've traded even during my PhD some strategies, but not focused on trend following, to be honest. We tried a lot of different things because I'm a fan of testing everything with real money. So I see if it really works. But there were definitely also, just if you come from the space of volatility, there were some things in there which were more on the other side of the distribution, like not the outliers to the right, but rather to the left, right? So you're kind of trying to pick up pennies in front of a steamroller, that kind of strategies, which worked well during that time until it didn't, of course, we know that. So that was also then the pivot to more the trend following world, where I saw a different perspective. I knew momentum in general, but I did not know the systems behind trend following in detail. So for me, from the academic side, it was all very similar, because risk management, for example, in the academic world usually means just kind of volatility-based risk management on portfolio level, but not this kind of trade-based position management that Moritz, for example, brought to the table and that he uses all the time. And in terms of I would say we kind of have some different skill sets there. I can definitely automate things. I can definitely put things into a production environment where it's really running very reliable. This is something I picked up also in between when we didn't work together. I worked at Scalable Capital, which is one of the largest digital wealth managers in Europe. Meanwhile, there it's all about building really robust strategies for trading. They meanwhile do as a brokerage and all of that. But this is something which works well. We all know that outside of Excel. But I would say in general, Moritz can do all the same stuff I do, just in a different programming environment, so to say.
Look, one of the things that trend followers particularly are accused of is the adoption of very simple models. Now, I was speaking the other day referring to it as naively simple. How do you view these models that we deploy in the trend following space? Can you explain it in terms that, with your background, explains it in a way that definitely states that it is not simple in a sort of in a naive sense?
Absolutely.
It is. Yeah, go ahead. Go ahead. No, you start. Okay. Go ahead.
It's definitely not simple. If you can boil something down into a simple model and it works, that is kind of the magic behind it. And that's the real kind of skill set. It's not the skill set of fitting hundreds of parameters and then you can fit the curve nicely. That is kind of the easy part. The hard part is really having two parameters or two kind of configurations, which can more or less be very robust across the whole range of trading, across different markets, across a long time horizon, and also in different circumstances. If you achieve that, that's the real skill, not the big models and all of that. In my opinion.
Are you big sort of are you both advocates of sort of absolute momentum, or do you dabble with cross-sectional momentum methods? What's your thoughts there?
Not using cross-sectional momentum at the moment. Coming back to your question about simplicity, I like the KISS approach. Keep it simple, Seibert. It's something that but as I alluded to, it's been a process to learn this, because it is so appealing. It is so motivating to do research, be that in Excel, be that in Python, and work with all the data and essentially outsmart yourself, right? Because there's always something that you can add to a system that will make its history look better. And it is very easy to then step into the trap and say, that is what I'll do. I'll add another filter. I'll add another rule. I'll give this whatever, a new exit, an additional exit rule. But all of these things make the history look beautiful. They don't necessarily, or they're very unlikely to make the future come, produce these returns that you've seen in the past. You can really only get there with these models, which I think you said, Richard, from the outside, they may look naive or too simplistic, or why would anybody pay us a fee for running these models? But as Moritz was saying, they're actually not that simple. Maybe the parameter settings and the way that they are setting code isn't all too complex, but you still need the experience and the character to follow these models. And to know when a model is good. This is what I think investors are paying us for, is that we're essentially truncating a part of the distribution very systematically. We're avoiding disasters. That is extremely important. We don't want to have any of these big accidents, right? We want to let the winners take care of themselves and develop to a space or a place in the distribution, wherever that's going to be. You're speaking about the tails. Hopefully it does go in the tails. Usually that is good for us, right? But we don't want to have any of these negative excursions where, a trade becomes such a big losing trade that it starts consuming the portfolio, not only the portfolio in terms of returns, but it also starts consuming you as a trader, as a person psychologically. That is just not part of the process. And this is all part of the framework. Like, the model is the generator, it sits in the middle, it's the engine that produces signals, but it's all a bigger thing, like a philosophy of trading where yes, we're using these relatively simple rules, but it is at the end of the day a piece of beauty. The entire framework that we run systematically, consistently, with patience, right, without giving up, with the fact that we accept volatility as a natural byproduct of what it is that we do. Because if we weren't able to do that, we wouldn't be able to run these models. These models, as anything that is robust and resilient, it is never robust and resilient on any given day, day after day after day after day. It takes time, which means that intermittently, and meanwhile, you will have volatility, you will have drawdown. This is to be expected. This is not to be avoided, and you need to be able to cope with that, accept that volatility, but then also, frame that for you and say that if you want to make returns, you cannot generate superior returns by avoiding all risks. You need to take risks cleverly, right? Not too much, but if you don't take risks, you can't expect to make any money. And I would say I'm still puzzled by a lot of the investor behavior that I think has come about over the last 15 years, where people wanted to have less and less volatility. We all used to be fine with, say, 20% equity vol, when the S&P was actually realizing 20% vol, or the SPY was realizing 20% vol. And then, yes, rates came down and the entire environment changed and new products came out, and nobody wanted to have 20% vol anymore. All of a sudden, 20% vol was far too high. It had to be 15 and then 10 and then even, below 10. But, think about it. If you're running a strategy at less than 10 vol, I mean, sure, the multi-strat funds and all these magicians, they leverage it up. I mean, I'm just, my risk-adjusted returns aren't in that category. But if I ran the trend following strategy at 8 vol, I'd ask myself, why do I do it in the first place? I mean, for me, it is, yes, I enjoy doing it. It gives me a lot of pleasure. It is my life. It is my dream life. But I'm also doing it to make money. At the end of the day, it needs to pay for stuff. And I therefore refuse to trade it at 8 vol. I don't need to trade it at 30 vol, but, always ask yourself, what is it that you want to get out of this trading stuff that you're doing? And for me, really, the only result can be you want to make money. It's the raw money at the end of the day that you want to produce.
It's a practical game. Rich, hold that thought for 1 sec.
Yep.
Don't forget it. Guys, as we're getting into your broader philosophical approach here, can I just drill down one layer deeper there in that, in all that you just said, Moritz, and ask about then could you maybe give us a little more colour around the process or the methodology that's employed there, the thinking behind the process that says, right, this is how we're building a robust strategy that we do believe will endure through time, that isn't curve fit. Can you maybe give us a couple of points around, what some of the process is, or the mechanisms or the controls or the thinking behind creating that platform? So how do we create a strategy that isn't curve fit?
Yeah. Well, making sure that it isn't curve fit is actually difficult, but the fewer parameters you use, the more likely you are that you aren't curve fitting to the past. But I guess some optimization and some curve fitting can never be avoided, because at the end of the day, you're working with data, you're creating the model, you're looking at the results, the statistics, the equity curve. And of course, you can change things. I mean, we have changed things. It's not just that we researched one model, like say 100 or 200 day breakout, donkey in and say, oh, that's it, we'll never look at anything else. Of course, we did look at a 180 day breakout and a 240 day breakout and, all sorts of other methods. And there is an inclination, of course, that you will go for the one that has worked best in the past. Now, we look at everything and kind of like create a heat map and say, okay, there's like a plateau, like a parameter range where these things tend to work. And it doesn't really matter whether like one setting, say a 200-day breakout produces a Sharpe of 0.5 and a 220-day breakout produces a Sharpe of 0.55. Who cares? Because whether that's going to be true next year and the year thereafter, it could just flip around. But you find the area where these things work in general. This is one element. We trade it across different markets. We want these markets to be as independent of one another as they can possibly be. And we want to trade as many of them as we can find. The less correlated they are, the better it is. And what's very important is to have a risk budget and give all these trades the same expectancy through sizing. So we have an initial stop. We don't really care whether we're trading Bund futures or the S&P 500 or crude oil. When we get a signal to trade them long or short, which by the way, we do both sides equally, we will just join the race, give it a go, but give them an appropriate sizing across the portfolio so that each of these markets and all the trades that we have on have an equal chance to contribute to the losses and the profits of the expected losses and profits of the portfolio. This is what we do. And then there's no hard feelings if it doesn't work out. This is the thing. Like a lot of these trades don't work, and it's extremely important to cut them, to just, like weeds, get them out of the portfolio. It doesn't mean that they can't come back in. I mean, oftentimes it happens that you're stopping out of a trade and 2 weeks later you're back into the race with the same thing, maybe in the opposite direction, maybe again in the same direction that you had originally on. But nevertheless, you need to avoid these disasters and these large losses, which can be devastating to your portfolios. So I'd rather take many of these small losing trades. They are a little bit annoying, but kind of over time I came to love them because they're a part of the system. And then every once in a while you have these massive gains, these big outlier trades that just keep on going and going and going, be it at the moment cocoa or sugar and OJ. I mean, there's a couple of trends that have been going on. I mean, the bond markets are still going down, where we're sitting on these open trade profits, and we'll let them go for as long as we can. At some point, I guess it'll stop, right? And there will be give back on the P&L. But this is...
As you're saying this, Moritz, I'm just checking Moritz Heiden's eyebrows and seeing if he's agreeing with you at every point you're making along here.
Yeah, hopefully. And this is also, by the way, this has become philosophy. Like the way we trade things at Takahe, also including the spreads, is governed by that framework of keeping losses small, having a defined risk budget, and allowing the outcome to be uncapped and unlimited to the upside. And this is really important. And we're not dabbling with these positions. we're not trimming them, we're not controlling them, we're not adjusting them as they develop. I don't think that is necessary. I actually think it is detrimental to do that. We just let them run. I mean, it's kind of like, I think of it as a hand that I'm playing at a blackjack table. You know, I got dealt these cards. I'm now playing them, and I'm playing the game till the end with the cards that I got. And it takes me wherever it takes me. So this sounds simple, right? Because as Richard was saying, like, you know, it isn't that simple. You know,
one of the things we've got to overcome is our biases for a start, which is a huge overcoming. You know, dealing in the space we're dealing with. You know,
exactly.
The simplicity we're observing is because we've overcome our biases.
Exactly, and I think this is again part of the experience, part of the journey. You know, Jerry is a friend of ours. He learned that, I guess, earlier than we did. He's fantastic at it, but it is exactly that mentality where most traders, most investors, most people, they would look at a profit and say, I really want to click the mouse now and take that profit. I want to take it home. I want to secure the money. I want that money out of the market and go and have a nice dinner or whatever, or buy a car, right? But this is our ability to have that open trade equity in the market and understand that it can still develop to a place that is almost unforeseeable. Like, you know, it can go way, way higher. We've seen these examples, you know, European natural gas last year, European power prices last year, of course, because of the Ukraine conflict, right? Look at the price of Tesla, look at the price of Amazon over time. I mean, when you look at these stocks or these markets at the moment, in the right here and the right now, and you see the chart, you think it can't go higher. It's very expensive. Like, let's say crude goes to 100. There's going to be a bunch of people that will say, well, it's at 100 now. It's very expensive. It shouldn't go higher than 100 because of fundamental reasons, and we're counting barrels and all that type of stuff. I don't have that view. I completely stripped myself of these opinions. I think crude can go wherever it wants to go. It can go to 200. It can go to 1,000. Maybe disconnect from fundamentals. I don't care. But in order to make the money, I need to be able to stay with that trade and keep it and not trim it, not play around with it, and also be prepared to give back some of the P&L that, you know, shows up in my trading account. And then I'll stop. This is the way I help myself do that, is to really see this open trade equity that shows up on the screen as, yes, it's money that I can get to. I can, as I've said, click the mouse and realize the profit. The way I think about it is, it's actually money that the market has given to me in the form of variation margin. It's a zero-sum game. And it is therefore money that I got because my position was right in somebody else's position, because it all sums up to zero, right? Somebody else has the opposing futures contract position. That other person is sitting at a loss, right? So I'm actually taking somebody else's money. I'm in this, I don't want to call it casino, but let's just say it's the casino market. So I'm playing with somebody else's money. What could be better than that? I mean, Rich, we go to the MGM in Las Vegas. We play, you know, blackjack with somebody else's money. We'll do that all day long. Right?
So does that open trade equity factor into your position sizing for new trades, or is that locked away until it's closed?
Yeah, I'll do that slightly different. I'll actually keep the trade level, which as futures traders, we can notionally define the trade level. I keep that constant for a relatively long period of time and trade the account at that level. And then I review it, you know, based on, you know, profits that I have realized, which then includes the open trade equity, and I will adjust the trade level. But I'm not...
That's a safe way to do it. It's sort of not embedding leverage into the process all the time by continuous adjustment. So it's actually a very conservative method, which I like, because I like actually reducing leverage in the portfolio at any instance.
Yeah, it's close to, say, sizing your position based on close trade equity as opposed to open trade equity. But when you do that, which is fine, you just look at your your close trade equity, and every time you get a new signal, you would be sizing it based on that close trade equity. I'm just even maybe a little bit more conservative sometimes, a little bit more aggressive sometimes. I keep a trade level at a certain level for a period of time, and then I review it once my P&L has changed significantly enough that I think it's now warranted to just the trade level. But
guys, can I bring you now back to the research function? Gives a chance for Moritz H to have a go. So, look. Clearly, you've got your views of where you're extracting your edge from this market, and I'd assume, with my knowledge of both of you, that this would have been a viewpoint that has come through your research process, not necessarily a philosophical view you've approached the market with. You've played in lots of different areas within the market, and your research process might have led you to this opinion. Would that be correct?
I would say it's a mix of both, right? Financial markets are never a natural science. We try to make them a way by defining systems on them and applying them. But in general, you have both components, like the philosophical or the behavioral component, and then kind of like what that makes out of this market, where we try to describe it as good as possible, or we try to kind of like pick something up from that market in a systematic fashion in our sense. But like, there is the research process, of course, is governed by statistical evidence, but our idea formation in general can come from many sources. So it's not that we are, for example, just data mining on various markets and we say, okay, this is kind of like our test that we apply, this is what the Sharpe ratio of that is, and that's what we want to have. But rather, we have that approach, but we also include different models from a philosophical point of view, where we just think that from a risk perspective, they fit into our bucket. So for example, we would probably not trade short vol. We don't do that. It does not fit into our belief system, for example. It's something we know and we could do, but it's just not what we do. We kind of like have a defined target, and everything that aligns with that from a strategy perspective in general, philosophically, is first of all interesting, and then comes the very defined research process. And to kind of like abstract that in a very easy way, I think like Moritz already said it, the most important thing is like, don't overfit. I mean, there are many measures you can look at, but the easiest one that I found, honestly, and that everyone can do, just write down which thing you back tested and make a list of it, and then count how many times you ran the same strategy with different parameter settings, sum it up, and then adjust your expectation by any way you like. You can either kind of like divide the Sharpe ratio by some constant that you derive from that number, or kind of like say, well, I run 1,000 backtests, so maybe this 1.5 Sharpe is not that reliable now in the end. So that helps a lot. And the other thing in the whole research process is buddying up with someone, which is also something that you cannot do systematically. But like the bullshit checker, basically, we have that, because Moritz and I, we are, I would say, very easy to kind of like be entertaining a new idea, but then we usually go to each other and fact check that. And we are also very critical. So we usually say really the truth to each other. So we don't have any incentive arguments to hide that, right? We are not in a business setting, and we always had that spirit. Even when we were in a business setting, we don't have to conform to anything. We can, if I fuck up, Moritz can say that to me. If he does, I say it to him. Or if we don't believe something, we just challenge the opinion.
Sorry, kids in Australia, for that language.
Sorry. I thought it's a late night show.
I've got to change my setting on iTunes on Apple to contain, anyway.
I've got three quick questions just before Simon, you take over. The first one, three quick questions for you. The first one is in relation to volatility of your strategies. Like, clearly, trend followers, we always get the, gosh, you're volatile, guys. But I'm thinking in this, where noise dominates the markets, they are very efficient you've got to accommodate that noise in your strategy. So volatility is actually what I see as a way of underfitting or ensuring you're not overfit to the markets. Have you done any research on this, or what's your view of the volatility of our technique?
You're asking clever Moritz or me?
Well, I don't know who's the cleverer. Either or.
I'm not sure I completely got the question. Are you saying, well, the markets are volatile? Is there anything that we would do against that volatility as we input
I'm
these
questioning
volatile
markets that produce. I'm questioning programs that produce high sharp, saying that they're actually warehousing risk in their strategies.
Yes.
And that volatility is actually a natural expression. It's a bit like me saying, if I see a smooth equity curve, I'm starting to sort of think in physics terms as though I'm heading towards perpetual motion machines, if you know what I mean. So
yes, you know what, Rich? I think good traders that survive and do this for 10, 20, 30, 40, 50 years. They're not the ones that are selling volatility. They're not the ones that are selling tails. They're not the ones that are exposing themselves to these silent risks. If you don't know so traders who really run out of ideas, traders who don't know anything else or who aren't good at understanding this, they opt at selling vol usually. Very often I've seen this, this, because this is the easiest thing to do. This is the straightforward thing. Is if you don't know better, if there's nothing else that you can think of, you end up selling volatility. And you see a bunch of these traders, you see a bunch of these strategies and model portfolios and indices, and they're all around short volatility, and of course, or carry, or a mix of them. Essentially finding things in the historical data or in the historical distribution around the mean where you can just sell it and say, okay, whatever I've observed in the past is going to stay around that mean very narrowly leptokurtic in that distribution, and therefore I can sell the tails, I can sell the volatility, and it'll stay there until it doesn't. Now, these return streams, they do produce a very high Sharpe ratio because nothing else is possible. Obviously, if you're sitting very close to that mean and everything is constrained there and you're selling the tails, then you're essentially making money every day, right? A little bit. And that may go on for years and years and years. But you do, as you say, warehouse that risk. You warehouse that silent risk, which to the naive trader, then they may not even be aware of the fact that they're doing it. Yeah. There are traders that are aware of the fact and they see it as a business, kind of like, well, I just need to be able to survive 10 years, money will come in, and then eventually I'll blow up.
Just explain as you're going, Moritz, a little more. I love that term, silent risk. So if you could just unpack that a little as you go.
Well, people, in these extreme tails or these events that can happen, they are, you can forecast them. It's that black swan. It is, it's that odd curveball that hits the markets, which you cannot anticipate. But you kind of like have to be cognizant of the fact that it does exist. We have seen this time and time again. These are the surprises, and we need to find an approach, and we do trade an approach that I'm not saying that we're 100% insured, because nobody is, against these surprises. We could have a position on that would result in a large loss, even as a trend following trader, because of a discontinuity event or a gap event, which is also, by the way, one of the reasons I dislike the term crisis alpha. I can definitely think of a crisis in the markets where CTAs and trend following traders won't be able to produce alpha simply because of the fact that we're positioned wrong in a bunch of markets, just because this is kind of like the cards that we were dealt by the markets. Hopefully we can get out of these positions and keep our losses small, and the discontinuity event isn't too much. The good thing is we're trading in liquid markets. We have a greater propensity, much greater likelihood to survive these periods. Maybe we'll take a loss, but somebody that's trading OTC, selling vol, not on a listed market, not on a lit market, these traders are much more likely to blow up because they can't get out of their position. Their collateral is called, all that type of stuff. And Simon, if you have skin in the game, you trade your own money, that just triggers a different behavior, right? We have our own money in the fund. definitely the last thing I want is to blow that up. I mean, I don't want that for reputational reasons. I feel absolutely horrible about it. But I also don't want that for financial reasons because it would hurt myself. So whatever it is that we do, it is protection first, risk management first. And these trend following strategies, they are inherently protective because of the fact that we're keeping losses small. And yet every day I get up, I think about these silent risks. Like, I've followed the things that are going on in the markets. I find it very interesting. Zero DTE options, for instance, is one of these phenomena right now, or developments right now, where I must say I do understand, how these options work and, the amount of gamma that they come with. I don't follow it closely enough to know where the gamma sits, in what direction, all that type of stuff. But I would nevertheless put it into the silent risk box for me, because even though there are 0-day options, they may not be, prone to, say, an overnight risk because they don't live at night, these options. But you could have a gap event. We've seen these massive sell-offs, right? I think in 2010, 2011, where you had this flash crash in the S&P 500. I mean, this happens during the day. If something like that happens, or in our lifetimes, I would bet that we will then hopefully live long enough to see a 10% intraday meltdown on the S&P 500. And why not? Things happen. And then then it is a silent risk in the sense that we know that these derivatives now sit there. They can have massive potential, massive velocity because of the gamma. We don't know which direction, but it could actually then move the index to -20. So I kind of look at the portfolio with that in mind. The treasury basis trade is another thing. There's things going on natural gas where it's just things are getting, market participants are getting so leveraged and so enthusiastic about these positions that it's like a spring that may jump back the other direction. And I just want to make sure that if and when that happens, I mean, I can never give you 100% hedge. But I want to be cognizant of these risks and make sure that we run a portfolio that will be in stealth mode and resilient against these moves. And therefore we trade a lot of markets. I don't want to be a one-trick pony where we're just saying, oh, we're only trading, say, the S&P 500 or vol on the S&P 500. I think that is extremely risky.
Yeah, so diversification is obviously another huge aspect to that.
Look, while we're on that, can we talk about, so there's two aspects here. One is the trading across uncorrelated markets, which obviously you can give us some guidance on, and the other is use of uncorrelated systems that you might be able to sort of give us guidance on there. So what are your thoughts there, guys?
Well, markets, as I've said before, the more we can find that are independent or moving independently of one another, that are really not atomically linked, like, crude oil and, say, corn. I mean, they're two very distinct markets. Therefore, they have a very important and very, they have a place in our portfolio for sure.
And in this search for uncorrelated markets, Moritz, are you going into sort of the exotics and the alternatives there? What are you doing there?
The non-standard CTA markets, yes, we would like to go there. I think this, Rich, is a function of AUM for us. I mean, we're essentially an emerging manager. We don't have that much money under management right now. If we added, say, the freight markets, the power markets, some interest rate swap markets, trading ISDA, I mean, it's something I'd be comfortable doing, but it wouldn't be a good use of our time at the moment because we'd be introducing an operational complexity into our trading process on a relatively small number of AUM, where it just would be overdoing it. But to answer your question, say we're getting to 100 million, 200 million, fingers crossed. I mean, we'd love to go there. Then I would definitely like to research and add these markets. And we have already done that. We have done the research onshore China commodities, which, by the way, are expensive to trade in any type of setup. But, the freight markets are a great example. The power markets in Europe, by the way, also in Australia, in New Zealand, in the US, you can trade futures. Today I had the quarters, the month, the years, base and peak. So there are some really interesting markets that we could relatively easily add. Maybe trade them through a broker. You need to find these broker relationships, by the way, as well. That is part of your edge, is to know who to trade them through, like who has the best and the biggest book, who runs the inventory, and who can give you the best price. And then maybe as a second step thereafter, but we're really talking probably a couple of years out, you could think about, okay, let's have a relationship with a bunch of banks, get an ISTA relationship going, and then you would be, trading swaps and all that. But I don't want to say, I'm not sure if we'll ever do that. I'd be intrigued. I'm very interested by it, but I also want to be very mindful of the risks and the complexities that come with it. Like, how much do I really gain by trading, or could we possibly gain by trading an interest rate swap or a cross-currency swap, Turkey, Colombia, whatever? Like, we hear these markets. Yes, maybe these markets are somewhat uncorrelated to other interest rate markets, but you would then have a different relationship in terms of risk with your counterparty that needs to be managed in a different way. It is no longer, some of that stuff can be centrally cleared now, and you'd be facing the clearinghouse, but some other things not. So it is also that, again, coming back to protection, like, the one thing that we want to make absolutely sure is that we're not blowing up the portfolio for some simple, foot fault. And, the MF Globals, all that type of stuff. It is not our business to take on credit risk and have opinions on the creditworthiness of counterparties. Other people do that. They trade credit and high yield and that type of stuff. And I'm just not good at that. That is not my zip code. I don't operate in that. And, I therefore, where we have excess cash and idle cash, we would put it into T-bills. I'm not willing to, take even a sliver of risk on credit there by buying a corporate bond. Don't need that.
So stick to what we know well, because there's not enough time in this world to do all of the research that we want to do. But
and there are a lot of risks.
That's right, and we're taking a lot of risk already through these futures contracts in 90 different markets. So really, also the level of volatility that we trade. Think about it that way. Whether we add another 30 basis points on, say, interest rate accrual because we went out the risk curve and took on some more credit risk, that at the end of the day should not move the needle and change the experience for us or any investor. If you trade at 20% vol, 30 basis points is less than a daily P&L, right? So why would I be taking any credit risk for an expected less than 1 day P&L? Just not worth it.
Speaking of all those markets adding that you could add, Moritz, what about stocks like Cherry? Would that appear, and have you done any testing on that?
Yeah, I'm definitely in Jerry's camp there. I think that breaking up the equity indices into their components, which are the single stocks.
And just explain to the viewers your rationale for that. It's a great rationale. I just wanted to hear it from you.
Yeah, these stocks among themselves, they're not correlated by one. We're looking at the index, the S&P 500 index, or any of these equity indices. They are a piece of beauty. They're actually momentum driven, right? Because over time they overweight the winners and the losers have to leave the index. So we're talking about a trend following or momentum type strategy here anyways. But there is a diversification benefit that can be realized and materialized inside the portfolio by breaking up these indices into their component parts, because a General Electric and a Coca-Cola and a Tesla don't correlate by one.
And long and short for both. Long and short for any constituent.
So, by the way, we're not doing that right now because our setup doesn't allow us to trade cash equities at the moment. We would like to get there. Again, that is a function of AUM growth and adding a different broker and a different setup to the fund so that we can trade cash equities, and then we will do that. Now, the long side for these stocks is easier than the short side because it's a funded position, or you can trade it on margin as well, depending on how you set it up. And you would buy shares of Coca-Cola in my example, or General Electric. The short is easier for these futures, right? Because they are very competitively priced in an institutional market. You can just as easily buy the S&P 500 futures contract as you can sell it. But selling some of these single stocks short is not as easy. I mean, the large names, probably not a problem. Coca-Cola, you want to short Coca-Cola? Yeah, fine. You can do that. But if you're maybe trading some of these smaller names, or they become special, right, which is that situation where something happens that is idiosyncratic to a given name that you're trading, then you may have some work to do with your short position. It can be called away from you. Your borrow cost may rise. You don't get as much rebate, etc., etc. So it is doable. I think it is, at the end of the day, probably a function of how do you break down the indices into its component parts. I don't think we would necessarily need to go into the micro caps and the small caps, where shorting will be much more difficult compared to, say, the larger names. But if you think about something like the MSCI World, where you have the largest stocks from Europe, from Australia, from Asia, from the US, and whatever, like you take the top 500 large cap names and look to find companies that have a specialized focus and run a business that is independent of the next company that you would pick. Like, you know, we were mentioning Munich Re. Munich Re is one of the largest reinsurers. They have exposure to catastrophe risk, weather risk, but it's an insurance business. They're not an automotive company, so we shouldn't expect them to be too correlated with BMW or Mercedes-Benz or Coca-Cola, right? So it's that type of thinking where find these different industries, these businesses that have a focus that is very distinct, put them together, make sure they're liquid, not too small. And I think by doing that, you will generate you're likely to generate a better experience than by trading the indices, simply because of the fact that you will have more diversification benefit added to your portfolio.
Tell me, just on a final one on the research, and then go for it, Moritz, after this. So, are there any? I know you guys do a lot of research with your two quants, as well as obviously with your Takahe. Is there any myths you'd like to bust with some of the research that you've undertaken? You know, the use of stops, all of these things. Is there anything you'd like to discuss there?
I think our main thing is always, our main issue was always with volatility targeting, in a sense, right? The big topic that Let's bring it on. Bring it on. Everyone has an opinion. I mean, we are not there we have reached our final verdict, I would say, or at least kind of close to the final verdict. But of course, there are different views on that, and there are also reasons why people do it. We generally don't do it. So we are not fans of scaling the volatility overall for the portfolio or for positions. Can you
just explain it to our listeners about volatility targeting, and then what your research is concluding there?
Yeah, so there are basically two different ways to manage risk, right? If you put on a trade, you can either put on the trade and go in, for example, with a fixed trade size or percentage of your equity and just keep it at that. Or you can dynamically adjust the position by some component of fluctuation in the market, which is kind of, for example, measured by volatility. And you would measure volatility over a certain time horizon and say, okay, dependent on that, I reduce risk if volatility on the portfolio or the position increases, and I increase risk if the volatility goes down. So if my perceived risk on the position goes down. And this is problematic for several reasons. First of all, volatility is, we all know, a kind of like very bad risk measure in general. It's symmetric, so you're measuring upside and downside risk the same way. There are some kind of like fixes you can do to that, so that's okay. But then what's usually done by people, they either apply it on the portfolio level, so they basically mix everything together, and then basically the whole portfolio is adjusted up or down in a way, which creates a weird dynamic because you're not treating the whole system individually across the positions, but you're really just kind of bundling it all together and then scale it up and down, which also has this strange way that you might reduce your position size actually on winning positions because they are just mixed together with losing positions or positions where the volatility is really an adverse effect in that way. So there are kind of like numerous studies on it. Some of them say it works well because it looks good in a backtest. In reality, it always depends. It introduces trading costs. There are some downsides to it. If you do it on certain position directions, it can get tricky. For example, if you have a short position on and volatility increases, which is usually correlated to kind of like downside movements, we know that historically, you would actually reduce the position size on a winning position just because kind of like markets are tanking while you are short, which makes no sense at all. So it's not a decent way of, in our opinion, to manage risk. It gives you more like the impression that you are in control and yet that you're managing risk, but in reality, it does not manage risk on the individual positions. And it introduces.
Would you say that it does smooth results, but it introduces negative skew into the portfolio?
Yeah, the skew is one thing we don't like, because as trend followers, we are looking for a certain distribution function. We know we have a lot of small losses, but we are looking for these outsized gains, basically. And that's kind of the distribution in returns that we are looking for from our trading. If you put these kind of like vol control on top of this, you will change this distribution. You are shifting it. You are moving it around. You're cutting not only kind of the left tail, but you're also cutting the right tail where you have these outsized winners. So you are kind of making it more behaved. And it comes at the benefit that the curve is smoother, that you can target a certain volatility if you like. But it kind of comes at the cost that actually what you set the strategy up to achieve is now ruled by an overlay. And like you can do it, but you have to be really aware that this is changing the whole game, basically. And we, in our opinion, we are aiming for a certain structure, for something we are targeting for, and we don't want anything except the raw system interfering with what we are aiming for. It would be a different story, for example, if we say, look, this is a target and that's how it looks like and that's what we want to do, but we don't want to do that.
Yeah.
The one thing maybe that I'll add to that, Richard and Simon, is in recent weeks or month on various podcasts, we've heard that the way we do it, I think it was said, okay, we're sampling volatility once, initially at trade inception, and then we assume that the sample that we've taken and what we've measured in terms of ATR or volatility is what we want to be guided by for the rest of that trade.
Yep.
And that's what we do. And then, but, you know, I can understand when they say, okay, now we're sampling volatility and ATR, volatility in that case, every day, say, or a couple of times a day or once a week, right? So along the path, over the time of the trade duration. Now, first off, because I'm only sampling once, yes, I could be sampling at a point in time where volatility is very low or very high, and that will then therefore determine my position size, and that can be good or bad. But one thing is for sure, by not sampling over and over and over again, I'm definitely saving on transaction costs. I'm definitely saving on commissions and bid offer spreads. And then, okay, so I should be, from just that cost perspective, I should be ahead. Now let's get into the skew and the distributional and correlation things that happen along the way. And one thing you were asking if there's anything, a myth that we would like to bust. I'm not sure if I can bust one thing, but what I've heard recently and what I really disagree with and what my data does not show, but I've heard people say that volatility tends to increase around turning points. And I don't really know what that means, because for us as quants, define what a turning point is. We may all be looking at a chart, and what looks like a turning point to you doesn't look like a turning point to me. It's a matter of perspective and time frame. A very long-term trend follower doesn't immediately see a turning point only because the market has been going down 2 or 3 or 4 or 5%, right? But somebody that's trading a very short-term model, a 2, 3, 4, 5% turnaround, call it, may actually result in the exit of the position. So what is a turning point, first of all, right? But then even when you look at, with the benefit of hindsight, at charts where a trend has stopped, because now we can see it. We can see only that one history that has developed, and we can see none of the alternative histories that may have developed. But we see the one that has developed and it has turned around. Say a long position started to go down. At that point, where it starts to go down, okay, yes, sometimes you have these amazing discontinuities because something happened in the market, but that's a gap. That is a massive addition of volatility. That is not volatility slowly increasing. Any vol control mechanism will not be able to forecast that or react to that because it happens so abruptly. But very often I see positions in my portfolio, let's say I'm long something, it's long, and then it starts going down, but it doesn't necessarily go down with more volatility or with a lot of speed.
Yeah.
In like the bond markets, it has this nice curve, and then I
can't see any correlated relationship in the volatility associated with the trend, particularly in our chaotic areas, the tail regions. I just don't see this firm relationship.
Exactly. In the tail regions, just forget about it. There you are chaotic, and I mean, this is why it is the chaotic tail. Prices do whatever they want to do. It's kind of like this. They jump around even, right? There's nothing that you can forecast in that part of the distribution. You have some markets where the relationship is, say, more profound. Equity markets, for instance, have a negative relationship between, spot and volatility. When spot prices go down, volatility tends to go up. But that relationship is not manifesting itself in the same way in some of the commodity markets, in the FX markets, in the bond markets. They are more smiley, or they don't have that negative skew at all. And what I just wouldn't be able to do now after all these years, and I'd feel sick to my stomach, is if I had, say, a long position. Say I had a long position in the bond markets, which is a position that we had for a long period of time, not now, but over the past decade, right? And then these bond markets go down. They don't go down with a lot of volatility. And let's just say that I ran this volatility control process, and this now tells me the position is now going against me, right? It's eating into the open trade equity that I explained to you at the beginning of the conversation. And I would now add to the position. The position, yes, it is from inception to where we are a winning trade, but I'm now the position is starting to lose money, and I would be adding to a position that starts to become a losing trade. It's kind of like, this is not what I've been, I've not been doing this to do 180 on my trading philosophy and risk taking. I'm not allowing any of these risk control processes to turn my trading system on their head and kick good trading principles, the good rules, out of the window. So this is one of the reasons, and there's so many examples where we could see this in the oil markets, for instance, when the prices went negative. I mean, we all got short oil. It became very volatile. You had this big short trade that was paying for a lot of the losing trades. And then it became so volatile that, a vol control mechanism reduced your position size to virtually zero. So you didn't get any of the benefit.
Yeah. As it swept through zero into negative territory. That was an amazing period.
Right. And then, Moritz and I were working on this paper where we don't want to be biased by all the opinions that we hear out there. I mean, you know our opinion, which is we don't do it. And our research, initial and ongoing, shows statistically that it increases the average loss we would have to trade larger and take more losses with this process switched on. When we put all these trades into a bucket, like we label them, which we can do, say this is a volatility control trade, long or short. We can sum up the commissions. We can assume that we're paying, say, half a tick bid off or an average, or maybe even a full tick, but because we're just, price takers, assume on these trades. And we put them all in a bucket, and you sum total it. What's the P&L? It's a red number.
Yeah.
So it does cost you money. It smoothes out some of the experience. It kind of like has this feel-good character, I think, where people can say, I have my value at risk under control. I have my volatility under control. It's always 10%, right? It's kind of like balancing the portfolio. But as I've said before, I don't care that much or at all about pointing the portfolio to 10% vol precisely.
Yeah.
Why? I don't care if it's 12% vol or 8% vol or 13 or 9. You know, over time it comes out at, say, roughly 10. But does it have to be? I don't see any reason why it has to be 10 at any given point in time.
It reminds me in accounting land of this
that?
term called window dressing. You know, the desired outcome that the managing director wants, as opposed to the realistic outcome that the business produces.
And it is a great method to raise AUM, to run the business, to tell your investors that you've got it under control. You're the captain of the ship. Every day you're doing something. You're never lazy. You know, Moritz and I, we love to be lazy. Sometimes there's just nothing to do. If there's nothing to do, we go play tennis and we leave the portfolio alone. But, you know, why would I be engaging in these things? If there's nothing to do, nothing a good trader, in my opinion, would do, then just don't do it. Yeah. And by not doing it, you're saving cost and commission. So this is, you run these vol control processes. It allows you to get a larger AUM because usually you tend to lower your volatility target, which means you trade smaller position sizes. You get more of a management fee. I get all of this. But to me, that has nothing to do with good trading. This is a business thing that you're doing. This is a marketing and communication thing that you're doing with your clients, where you come across as this risk manager every day. I don't think it is necessary. I actually think it costs money. It is unnecessary, and it has nothing to do with good trading principles.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals or objectives, so nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.